Hey, good morning. How you all doing this morning? I see that you're watching Fox Business News. Sorry, I got a couple of glasses here, but there's some glare from the lights while we're recording, so I change glasses. Uh, my name is Roy Idrach. Uh, I'm 84 years old, and I've been trading commodity and stocks in 1972. So that makes it about 52 years. So I'm considered to be a day trader. As you all know, we've been doing the short analysis uh, studies and seminars. We're conducting this at the Wilson County Library. It's available to anyone in the internet, and it's all free of charge. We had done the first 5 parts that include chart analysis, and now we're going to put together all our knowledge and what we learned to him, put him into practice. When I started trading back in 1972, I was trading commodities and such as oil and copper. And I decided to do options. By 1975, I figured that we had to take less risk. So when we do options, we know upfront how much we can lose. Okay? There's a certain trade with options, and that's what I specialize on, where you could lose some money. It's a very risky business. I don't want to deny it. And this is what we need, opportunities. So what we're going to do here today is I'm going to teach you and show you how you can take what you learn from learning how to read the charts and now apply it into trading options. Now, let me tell you that you can do that just with stocks, commodities, currency, mutual funds, ETF, and so on. So it's not limit to just stocks or commodities. It's just about anything nowadays with the technology that we have, we can trade with option. However, let me advise you that it's not for everybody. And it's very tempting because a lot of money can be made, but then again, if it get out of hand, you can also lose your investment. And this is what we're going to cover. We're going to show you how you can trade options based on opportunity that happen in the market. You don't want to trade every day, and because this is how 90% of the people lose all the money. Today, thanks to the technology and easier to do things, I'm going to cover what you need to do and your plan. And I want you to look at this in a way that is anybody can do it. You know, it's just you need to apply yourself. But let's take, for example, you got to consider yourself a general. You got an army, and that army is the money that you have to invest. For every dollar that you have is a soldier that you have, okay? And we have to change the way of thinking. If we start charging on credit, and so every time we spend money not wisely, we're killing soldiers. And what eventually will happen is when we get to be old like me, 84 years old, you might find yourself in a situation where you are a general without an army. And life is very expensive, taxes are very expensive, and you find yourself in a very difficult situation. So part of my trading and investing and be successful at it is because I knew that when I get old, what I get on a pension, it probably won't be enough, and then I will not be able to work. So this is what I do now. I just retired about 8 years ago and just keep on trading options and doing very well. So I'm going to share the knowledge with you, and this part going to do with options. And remember, like I said before, This can be applied to anything. On this video, when I use the word stocks, that means anything that you could trade in options. I specialize in options, and I actually just use stock options to trade. I use a lot of them with advanced micro device, Apple, Generac, and so on. And I don't buy the stock. And I'm going to tell you why I don't buy stock also. The reason I don't buy stock is a good investment. You got a built-in a percentage of inflation that if you invest wisely for 20 years, you always make money. However, at my age of 84, I don't have time for 20 years. I probably won't be here next week to do the next lesson. At 84, life expectancy is 80. I already passed that, so I'm living in borrowed time. Just a joke. So let's start by lesson number 6, part 6 of chart analysis for the Wilson County Library. Thank you for your time, and I see you on the other side. Good morning again. Here we are on the other side, and of course you know me. My name is Roy Idrach. I'm a day trader, and I specialize in trading options. So I've been doing this for 52 years in 1972. So let's move to our first slide. And this is when you start, you learn already, you're reading charts, you understand the analysis of charts, and now you're going to put it into practice, and this is where the rubber meets the road. You need to develop rules, and those rules are for your own benefit. You don't follow the rules, you're going to be in trouble, okay? And this is why 90% of the traders lose 90% of the money in 90 days. Trading without a plan is like jumping out of a plane and no parachute. A plan must be followed and must be like making bread. You know what a baker does, right? He get up early every morning, fire up the oven, and start making bread. We do the same thing. We get up in the morning, check the market in Europe, and then we see how it go and take a shower, have breakfast, and be ready for 8:30 in the morning to start making dough, big dollars. If the opportunity is not there, you should not trade. Okay? We trade on opportunity, and you're probably going to see that I'm going to repeat this over and over. What your plan should include. You should choose a specialty. Whether you're going to buy and sell a stock daily is no problem. In my case, I specialize in options. That's all I do. If you're going to be doing bonds, you must specialize and know everything about bonds, commodities, or crypto. Whatever you want to do, make sure you are an expert. And you're going to see why later on. B, and this is a big one, when to trade. You cannot trade every day to make money, okay? It's just that simple. I'm going to repeat it again. You cannot trade every day and make money. You're going to get burned. Now, we go to C and we talk about money. How much you going to trade? Don't go crazy putting money into something that you don't know the outcome, okay? So how much you going to trade? You want to make sure that the amount you're going to trade, like I do in option, I know in advance that if something go wrong, how much I'm going to lose, okay? So the best thing to do is my advice. If you plan to buy 100 contracts on an option, buy 5 first. Make sure that the trade is going the right direction, before you buy the other 95. Get your feet wet in the pool. If the water is cold, get out, and if it's too hot, the same. D. When to get in and when to get out. You are in the trade. You bought your 10 contracts on the option. The market is moving in the direction. Remember that I told you this opportunity lasts about 30 to 45 minutes. So is it going your way? Now we go ahead and boom, drop in the other 90 contract, and we have to check the time that the trend been going. So you've been in a trade for more than 30 minutes and it's going your way. Please get out. Don't wait, don't get greedy, don't trade on emotion. You can hurt. Before you know it, the market start going down, the stock going down. You say, well, it's going to go back up, and then all the money you make could be lost, so 50% of it is gone. So never, never, now we are in E, don't trade on emotion. You should not get in love with numbers, with brand. Oh, I love Apple. I like to trade with Exxon because my dad worked on Exxon. Don't do that. The stock, Exxon, Apple, Microsoft, they don't know your name and they could care less. Those are numbers, and that's all we're interested in. The numbers got to go on the same direction that we want to when we trade in option. So remember this part, like I talk about the general without no money, right? Every time you lose money, you are killing a soldier. And if you kill too many soldiers in your life because of bad decision, even though you are not a trader, guess what? When you get my age at 84, you're going to be a general without an army, and I don't want that to happen to you. So a plan is a must. You are the general, and you're going to plan this perfect before you send your soldiers out for the killing. They're going to go and conquer. They're going to go and bring you more money, not to get killed on it. Let's go to the next slide. And here you are. You are the 5-star general. You are the commander. You are in charge. You are the one in charge. You got to take command of your life. Get on this uniform, my friend. Get in it and go out and conquer. That's what you need to do. Here's your powerful army, your strategy, your knowledge, what I'm about to teach you. All those things, when you see the opportunity, take it. Don't worry if you're making 20s, or 100s, or 50. We take whatever we can get on that opportunity. Opportunity is the key, and opportunity normally lasts 30 minutes to 45 minutes. I don't care the stock go up all day. I don't want to be there. Tomorrow be another day. I only look for opportunity because we're dealing with option. That's my specialty. An option can lose value very quick. So remember that. You are in command and you can take care of change your life when you got what? Your army. And this is what you got. You got a weapon of mass destruction here. You're going to kill it when you hit the market. You make a killing, bring it up 45 minutes, go and play golf. Do something else. Go and visit your mother, your friend, take care of your son, take him for a vacation or whatever, and let somebody else finance it. Go and buy homes, to flip homes or whatever with the money you make on the stock market. You want to be a millionaire before you know it. So let's move to the next one. Sometimes I get excited about this because I love what I do. Let's get to the legalities. Legalities are usual, right? I'm talking a lot, and I got a deficiency in my speech, so that also makes it hard. But that haven't keeping me from making trades and making $5,000-$10,000. So whatever people say about me, I don't really care. What he do? He's grammar is horrible. Well, my banker don't think so. I say, you're doing very well, Roy. Don't worry about the grammar. We got a PhD. I got a PhD, and I don't make the money you do. I work for the bank. Anyway, options carry a high level of risk and are not suitable for all of us. Not everyone can trade options. Believe me. The reason is that option is something that when you look at it, it's just an electronic document that you got involved in it that is not tangible. You cannot get a stock certificate even nowadays, but you can order one for your stock, something that you got. You got a title on your car, but when it comes to option, it's a daily option, like you trade the S&P, it disappears overnight. It's not there tomorrow. If you trade weekly option, by Friday, they're gone. Even so, the closing date is on Saturday, but there's not much you can do because what? Saturday, the market is not open. So all the options that expire with 5 and 10 cents at the end of Friday at 3 o'clock, if they are not executed, that money goes to some people's pockets, something you should know about it. The expiration on an option is on Saturday, on a weekly option, but the markets are closed. So any residual value that the brokers or whatever, they keep it to themselves or they split them up themselves. And that's the Chicago Board Exchange where most of those options are handled. But it's something to know. They don't last forever. Certain requirements must be made in order for you to trade options with your broker. If your broker don't give you this book or tell you to read it or don't send you a copy of it, be extremely careful who you're dealing with. This is required by law. It's not if he want to do it. He should make sure that you read the risk standards option booklet. Let me tell you, if you get involved in more fancy strategies, trading option, I only like to do puts and call. I don't do nothing else. I want to keep it simple. I go in, get out, no problem. I don't do no margins. I do everything in cash. Multiple leg options sometimes, right? If you get involved something like that, remember that you get multiple commissions. A lot of the stuff is not free. Long option, trade investor might lose 100% of the money. In other words, the fund that it was invested. So don't stay there if it don't going your way. Cash it in because tomorrow's another day. At least you will have money to trade. The spread trading must be doing margin account. So this is all the technicality that I should disclose because I'm not a financial advisor and I'm not trying to be one. I'm only telling you by my experience. Okay? And I have been very successful, so I try to give you the best knowledge I got. Now, short-term option can be assigned at any time up to expiration, regardless whether they are in the money or not, regardless what is in the amount. So think about that. I've been called 3 times in my life about options. I was selling options on Valero Energy, and one day my stock disappeared from the account. I called the broker. He said, "Oh, you been what? You been assigned, brother. You're gonna get the money in 3 days, and you keep the premium of the stock, but somebody liked your stock and they assign it." So when you write couple call, this is what happened. Okay, you can be assigned on all this kind of stuff. Option are short-living instrument, like I mentioned before. Weekly option position require close monitoring because of what? It can be subject to significant volatility. I had day that I had gone get into an option and I bought it out of the money, and guess what happened? The price went against me, and all of a sudden I was $6,000 in the hole, and I almost could be crying. I almost cried. I needed to get out, and then I quit trading for corporate day to get my emotions out and don't be trading on emotion. The probability analysis results show that such of probability of an auction expiring in the money are only a theory, okay? And only you have a crystal ball to see the future, I recommend that don't believe anything that they tell you in the news. Don't believe anything you read in the newspaper, because if they have a system or they have a secret way to trade, why they gonna give it to you for free or even sell it to you? Why they don't give it to the relative? You know, let me call my uncle, tell him about this deal. They don't want to tell you, and they don't want to tell me either. We are the little guy on this game. There are people that make $1.2 million an hour trading a stock. You know, we just a little fish in a big pond. A stop loss order are not guaranteed. And what I mean by that is that maybe you put a stop loss on your option and the price next day open below your stop loss, the order is going to get executed. So there's no guarantee that they'll be able to get you the money that you want. The stop and limit orders offer the same risk, missing the market altogether. So you might put a limit order, well, I want to buy the option at $3, but the option keep on going up or going down as it's a put, and it keep on going in value, so it never reach the price that you want to pay. And we'll talk about that later, about spreads and all that kind of stuff on it. Now, when to trade? Trade only on opportunity, like I've been saying before. Trade only on opportunity. Master day trading short term. Make sure that you understand what's going on and what you're about to do before you put the money into. Remember, you don't want to kill your soldiers. You got an army to conquer and not to be killing your soldiers. Specialize on a weekly options only. Okay? Some brokers don't let you trade on the last day of expiration, like on Friday. Well, I've been dealing with Fidelity Investment, and this is not talking or promoting Fidelity. I just do business with them, and as you're going to see later, eventually you will see Fidelity in there. They don't let you trade option on expiration date. A lot of people get upset about that. Oh no, this and that. Well, be careful. Fidelity knows, and they're trying to protect you. You could get assigned on Friday, and you have to come up with the money, and if you don't have the fund, it could be risky. So therefore, Fidelity, now Red Bull or some other, I just mentioned that company, but the other one like Robinhood, people tell me that they do let them trade on Friday. But if one of those days you get caught on the wrong side of the street, then you're going to find out, and don't blame them. I've been telling you now, okay? A premium spread can kill your trade. Many trades have 50-cent spread between the ask and the bet price. So if I'm buying 10 contracts and my bet is 50 cents, that means that when I execute my option and buy 10 contracts, which would be equivalent to 1,000 shares, it's going to cost me $500 on the spread. I'm going to start $500 negative. That is a problem. Because when I sell, I'm also going to sell 50 cents less on the spread than what it's worth. So that means that the first $1,000 that I make is for the spread, for the market maker. So I got to make $3,000 in order to make two. That's 33% spread that I don't like to deal with. So this is what I normally do, is check for the spread And like I deal with advanced micro device a lot, Apple, and you notice that it might be only 2 cents different. Well, that makes a difference because I'm buying 1,000 contract. I mean, if I buy 100 contract, so that's going to be 1,000 shares, and I'm only going to pay 2 cents per share. I might not even pay $50 on this deal. So that's something that you need to be aware of it. The premium spread can kill your trade. The next one is don't trade daily. This is what people get killed. They lose money. Not every day there's the opportunity I'm talking about. And the market open in the morning and yeah, oh man, it was going up. Pre-market is $2 up. I'm going to jump in it because it's going to go to 5. And then 10 minutes later, the thing dropped $5 and you already killing a whole bunch of soldiers. Something else very important when you are day trading. Turn your cell phone off, turn the landline off, lock the door, don't let anybody bother you. No phone call, no TV set, no visitors. Don't even have an argument with your wife or your girlfriend because you're going to mess up big time. You can have no worries when you enter this thing. You have to have a clear mind. If you are in debt right now and you're trying to trade to get out of debt, I'm going to warn you. I have seen a lot of people get killed and get deeper in debt. Okay? This is just like going into a casino and try to make your retirement because you're going to win the jackpot. Yeah, go ahead and try it. Those big palaces they got in Las Vegas are not made because people are making money. They are made because it's financed by people that are losing money. So remember, you have to have your mind clear. Don't worry or anything else like that. If you're behind in your payment and you think you're going to make it on the payment on your car and you're going to go and trade this money to go and make the payment in the afternoon, be extremely careful. It might backfire because you got worried. Your mind is not thinking right. I've seen people take money to buy a crash shaft ticket, and that was their house payment because they were sure they were going to win. And then the people knocking on the door repossessing their home. So don't treat investing or trading options like gambling. This has to be a calculated risk, and you only deal on opportunities. Opportunity is the key. If there's no opportunity, please, please, please don't trade. It's going to cost you money, all right? So don't blame me. He said, well, I did what he said and I failed. Well, maybe you missed it. This is something else you need to know about stocks and options. When you buy a stock and you take a position in a stock and you take a position on an option contract, a stock is something that can be delivered to you if you want the certificate. You own it. Options, you don't have no ownership, as you can see here. The stock, you own it. And I got one of the biggest collections on a stock certificate that they've been canceled. Nowadays, it's electronic. They don't send you the paper. And some companies, if you want the certificate, they charge you $500. An option, you don't have no ownership. This thing within 3 days, you trade in the S&P 500, expire the same day. Now you can trade expire daily. You go in the morning, if the broker lets you do it, which Fidelity done, you have to trade next day. And by 4 o'clock or 3 o'clock when the market closes, it's over, it expires. You either make money or lose money. When you trade those, then you have to do like me. We're going in for 30 minutes, 45 minutes, and we're out. A stock don't have expiration. You can own a stock forever. But options, you cannot own them forever. Sooner or later, they come and knock on your door. Hello, I expire and I expire worthless and your money is gone. Or I'm about to expire and you're in the money and you be celebrating and happy like crazy. Ownership on a stock costs more, okay? You're going to buy 100 shares of Apple for $100, so you got to take 100 times what? 100. You need $10,000. But an option costs less. We can buy an option for 100 shares and have $3.50 in the money times 100. Hey, I only need $350 to control 100 shares of Apple. And because it costs less and you can make a lot of money, this is why it's so lucrative and dangerous. It's very attractive. A lot of people say, man, I can make a killing. And what happens is sometimes they get killed. A stock gives dividends, option contract don't give nothing. It expires, that's it. Okay, so you buy a stock, you don't have no premium. A premium is like an insurance company. You pay $100 a month for guarantee on your car that if you have an accident, somebody going to pay. Okay, but at the end of the month, the insurance company tell you, hey, guess what? I was right. You didn't have no accident. Thank you for the $100, and you got to pay another $100 every month. It's just that simple. Options are the same way. They got premium, and that premium ends, and it ends very quickly. It deteriorates in the last few days. It's just going down very fast. Now we're going to talk about the ask and bid price, and like I mentioned before, you need to check what the bid and ask is and see the difference to see how much it's going to cost you. A stock that they say is commission free, they have bid and ask prices, right? There are not such things as commission free. Don't believe that. You do that, you believe in Santa Claus. I'm going to tell you why. I used to buy 1,000 shares of any company, Valero, Tesoro Petroleum, AT&T, McDonald's, about 10,000 shares of McDonald's, and they told me it's $10. That's all you pay. Back in the 60s, 70s, when I started, it was $65 for just to place an order on the phone. Now technology helps us do this much faster and cheaply. But you got to realize that the broker had to pay rent. They got to pay their employees. They got to do the paperwork. They got to pay the exchange. So we cannot be selling a stock for free. You know, there's no way. You don't get groceries for free at the store either, unless the government finances it through food stamps, right? So this is the same thing here. What happening now is the bid and the ask price got wider. So before, if you bought 1,000 shares, you paid $10 and that was it. If you bought 50 shares, it was $10 anyway. Now they tell you they're not commission, but the market maker got to make his money on what? On the bid and ask price. No different than when you go and buy gold. You go and buy gold and they tell you it's $1,000 an ounce, but the dealer charge you $10 for every ounce. So how many ounces you want? On the stock it's the same thing now. You see the bid and the ask and maybe 10 cents. So you bought 1,000 shares, that means you're gonna have to come up with $100 when before you used to get them for $10. So there's no free. And that's what I got the question mark here. So much about that, sometimes I get carried away, but options also have bid and ask, and they have, the more active the option is, the closer is the bid and ask price. The less trading is, the market maker protect himself and then he want more money. But I deal in 100 contracts. I deal with 10 contracts. So if I place an order for 10 contracts and that's 1,000 shares, and it got 50 cents, guess what? I'm going to pay $500 for commission on that before I can make any money. And when I sell it, he's going to take it from me away. He's going to get it sold, but he's going to be at the bid price, which is lower than the ask. So I need $1,000 in order to break even before I make commission. So I'm very careful when I deal in option that the bid and the ask will be 3 or 4 cents and no more than that. And if it's not, we're not going to deal with it because this is part of the opportunity. I'm here to get rich, not to make somebody rich. That's just like paying taxes. So there is a commission fee, and on the stock they say that it's free. So we'll see about that. But commission free, I don't think there are. Well, let's get to the next slide. Here comes the 90-90 rule. Do you know that these all brokers know about this rule because they had to deal with people going open an account for trading, and 90% of those new accounts, 90% of the new account owner lose 90% of the money in 90 days. That's what it means. The meaning of the 90-90 rule is that 90% of the traders lose 90% of the money in 90 days. So if a guy starts with $10,000, that means that by 90 days he only got $1,000 on the account. Okay, they lose 90% of the money in 90 days. Think about it. Because you're new in this business, that can happen to you. And this is why you see in the evening news and financial network and stuff like that, that these are all these different companies advertising about, come and do business with us, we give you this, we give you that, swing, all that kind of stuff, because they need to replace those accounts. They gotta get new customers. The poor guy that lost 90% of the money, he probably is crying at home, and his wife is after him because look what you did. Now we don't even have money to eat for our children. So this is why you gotta be extremely careful, and you gotta be a general, don't want to killing soldier, because these people lose the money. They don't know what they're doing. And I try to teach you the best way of doing it. I've been successful at it. I don't need the money nowadays. I don't have much time to live, but if I pass it on to somebody else, that's great. So, as you know, we do this also for the library, the Wilson County Library. We plug them in because I donate a lot of that time for the community. Now, let's look at what happened with an option. Let's say there are many ways of options, okay? So we can iron butterfly. This is more advanced deal that I don't going to discuss here. But if you go to, I forgot the name of the company, Investopedia, you go over there, they give you all this training, and it's also free. They're just like me. So this is what I normally do, and I tell just so you get an idea what happens when you buy a put. So what are we doing when we buy a put? We had the right to sell a stock that we don't even own, right? So this is actually what I mean, but you don't have no obligation to do that. So you can buy a put, and the price go down, you make money, and the price goes up, you get killed. So you gotta see the opportunity, you gotta match the trend, you gotta see that it's moving on that direction before you send your soldiers to work. You don't gonna send the army and a wild chase, and then somebody go drop a bomb on them, and you kill a whole bunch of soldiers. So the risk is what? The premium. If you stay there too long and you don't pull your soldiers out, you can lose the premium if the market goes on the other direction. You are limited to profit. Why you are limited in a put? Well, they say that you are limit profit because the stock can only go down to zero. In theory, the stock can go down to zero. In reality, that ain't going to happen in 1 week, right? But that's what you see, limited profit. The opposite happened, but we'll go later into that one. Now, the expectation of the risk. For you to make money, right, and the premium to go up, that's what I have in red, the expectation is that the stock will go down, you see? The stock has to go down in order for you to make any money. Now, the disadvantage is that your premium evaporate quickly because we did in weekly option, so it's very nervous. The timing force is very short, 1 week, and you need to be worried that if something go wrong, the performance has to be this way. The stock has to be going down, tick, 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 down. Downtrend. Is it not trending down and you're doing day trading? There's no need to buy a put because you're going to say, oh, well, it's going up, but then go back up, go back down again. Yeah, really. You don't have a crystal ball, my friend. Don't do it. Okay? So this is where I got this worry face over here, all right? I try to make things happy, you know. Now, what happens when you buy a call? Now, when you buy the call, it's the opposite of a put. You got the right to buy, but you're not obligated to buy it either. At the end of the expiration day, you bought a call and the price went up. Guess what? You just sell your option, take in the profit, and that's it. The risk and reward is the same, right? Cost of the premium. Option, always the premium is your risk. That's the most you can lose. However, because the price can go up, in theory, it says that you have infinite profit. Well, I know one thing. You don't get a stock that is going to go $1,000 in 1 day. All right? It might go $1,000 in a year, so infinite, that's not going to happen. But with option, you can make a lot of money. You got 10 contract, you got 100 contract, you can make $30,000, $40,000 in 30 minutes, 1 hour. And I'm going to show you some of those trades coming up. Now, the risk expectation, right? Now the risk is down. You lose money, you lose your premium, right? That's what is red, if the price of the stock goes down. But if the price of the stock goes up, that's what we want over here on the stock performance, then of course it goes up. You're making money and you're going to be a happy camper. But we had the same problem, right? Timing force. Even if the price keep on going up, your option premium eventually disappear. But this is in another class. We have some seminars where we show what happened to the option price and the money that is in the money on the option. So there are two separate things on this. The premium and the intrinsic value of the stock that is moving on the option. So you might have $1,000 in an option where $500 is the premium that you pay, and the $500 is what it went up above in the money. If the price remained the same at the expiration date, your option only going to worth what is in the money, $500, and the other $500 disappeared. That's what you paid. So this is what timing force is kind of worryful. Now here's a more safe way to make money. You can sell a cover call, but To do that, you need to have money. You buy 1,000 shares for $100, you need to have 10,000 shares. Then you go and write a cover call, and they say, okay, you got 1,000 shares, and the option is $5, so they're gonna put, you know, $500 on your account, and by Friday, when the stock market closed, if the stock went up $3 and you bought it for 100 and now it's 103, and your option was for 105, so he's not in the money, you're going to keep the stock and the premium. But if he's in the money, he's going to call it, and you have to deliver. You're obligated to let it go. They be selling it. Your broker will sell it for you. Remove that, give you the premium and the other money that you made on the stock, and it's over and done. You get credit and then limited losses. It's only limit to what? To the premium. It's something will have to happen. So now, what is the risk expectation? Well, if the stock goes down, you're going to keep the premium. You're going to keep the premium, right? So you're going to make money. So it could be both ways. That's what I got up. You're going to keep the premium. But let's say that the premium was $500 and the stock dropped $10 in a week. Do you make any money? No. Your stock now went from $100 to $90. So what you make on the premium, you lost it on the stock. And if it went down to 15, then you'll be on the red, right? The $500, it only help you cover some of the losses. On the other side, let's say that the stock kind of goes sideways and the price go not at the striking price, so you're going to keep the premium and you're going to keep the stock also. Over here you lose money, over here you make money, and you still have the stock. All right? This is what happens also when the stock goes sideways. If the stock goes up and it reaches the strike premium, the strike price, they're going to call it. You have to deliver it. That's fine. You're going to be a happy camper, right? Because you made money. You got your money back. All the soldiers are back in the camp, but you see, the price went down too much below the premium that you got, what? Then you might have to cry a little bit, right? If the stock goes sideways, hey, you're going to keep the premium and the stock. If the stock goes up, like we're showing over here in the stock performance, you might get a call if it go above the strike price. But if it go down, it might kill you right here, right? You just recover some of your losses with that, so you could be crying or you could be very happy. Now, how about if you sell a puts for cash? This is a different story. You are obligated. You got to be careful with this one, because what happened here is you got to leave a cash deposit for the premium, right? And you can risk a loss. So when you sell a put, right, you're expecting the stock. The expectation is that the stock gonna go up. So the put that you sold become worthless. Zero money by Friday, and the stock need to go down so you to make money. So you're gonna be real happy camper, because the stock went skyrocket and the put became worthless by Friday. But if the stock start going down and it go below your strike price, guess what happened? You're going to cry, because you're going to make up all that loss. Good thing about it, right? You always can call it off. Let me get out, take the loss, or little loss, or no loss, or whatever, and get out. So this is actually what we deal with, that I deal with. Now, we're going to have a video, and you can go to Investopedia and you can read this. They got a section there about stock options, and they explain to you this is more advanced subject beyond what the scope of this uh, part 6 is, well, you can do Mary put, bull call spread, bear put spread, protected color, launch strangles, and some of them, no matter which way the market goes, you make some money. But this is not the scope of this section that we're doing here on part 6 of understanding and analyzing charts. So let's move to our next slide. And here we go. We're going to look at, try to simulate option contract, and this is how fidelity window look. And we're saying that it's February the 9th, 2024, and it was on a Friday. My advanced micro device, it was at 172.48 cents. So stock price is 172, and we would like to buy a call. Right? It's obvious that this is going to go longer, so we would like to go a call and to buy the next price, saying it's 172.48, is almost at the money. We're going to buy something a little bit cheaper because the 172.50 already costs $4.15. You see the bet, and they ask, this is what that the market maker want. They want $4.15. But look at the difference, $3.95 on the bet. So $3.95 and 15, so we have it in here, 5 cents to $4.15. We got 20 cents spread on this one. Over here, if we buy a 175 call, we only have what? 99 cents to 90, and 2 cents over here, 11 cents different. This 11 cents of this. We also have open interest, 14,000 contract, and the market makers always exaggerate the implied volatility. We notice here they say 42%. So they say, what they're saying is that this price can move 42% on either direction. Maybe so, maybe not. But I'm going to tell you a little secret if you didn't know it. But implied volatility is in the best interest of the market makers to make it higher than what it actually is. And the reason is that allows them to jack up the price on the option, buddy. How about that cookies? We can increase the premium a little bit more if we get this to go up. On the delta, when we look here, what we're saying is that for every dollar the stock goes up, you're going to get about 41 cents. So in other words, the stock goes up $5, your option don't going to go $5. It's going to go up 41.79, not even half a cent yet. But notice that as the option is in the money, then you start gaining more money per dollar. Eventually, it never gets to 100%, but if we look at a call of 162.50, notice how here it's almost 90 cents for every dollar that the stock goes up. Okay? So this is good to know, and a short description. You can review the video again and to understand this. And we don't have no Q&A on this video. So here what happened. We're going to buy it at 175, all right? And we're going to have to pay $2.99 because we're going to get at a market price, okay? We're going to buy it at a market price, not on a limit order. Limit order, it might never get there, the price go up, so it never fail. Or the price will have to cut down to what you're willing to pay. So market price is going to be $2.99, and we do the math. We buy 2 contracts at the ask price, and we're going to, it's just good to cancel, right? You always can sell it or buy it back later, sell it later at the market price. So that's $2.99 times 2 contracts, 100 shares. They're going to be $5.98. And the $5.98 going to give me $598 plus $7 and 50 cent commission, and few cents that the government gonna charge me for be trading, so the federal government get a little cut too, Fed fee. So 15.95. The total for everything is $613.15. I normally round it up because I don't like to pennies and I'm not too good at math or grammar, okay? And you probably know that by now. But I'm good at doing options. Now let's simulate a trade. So what we're going to do here, we're going to move to our next trade. So 2/9, this is the deal. February the 9th on Friday, and I don't know if it's going to expire or something like that, but let's go and see what happens. So now here we go, and we got the option, and guess what? The 172, the price now, the stock price 172.48, right? We executed the order. You now you own you you open two contracts. I buy micro device 172.50. Your striking price, and you out of the money 52 cents. You are not obligated to buy the stock. You can sell at any time before or let expire. That is your choice. Is it losing money? Is it losing money? You might. Is it go against you? And if price start dropping, then you're not going to make no money on this call. And in some time the commission is more than what the option worth, so you just let it expire. But on this case, we're lucky day today at 172.50. So let's see what happened next day. Well, here we are now. Next day, market open, and guess what? 172.50. That was used to be 299. Now it was. Why? Oh, well, look at that. We are up to 175. The price went up. So now we are Monday morning. The stock opened, market opened, and it jumped up to 175. It's up $2.72 from Friday. Close, and now you are in the money, babe. We're making money. And the stock is 175.75. So now 415, your option that it used to be something like 613, now you are $830 right here. And the bet is 790. You see what happened? You got this much, but when you sell it, this is what you're going to get if you do a market price. Look at it. 395 times 2 or 4 times 15, right? So it was $830. It's in the money, but this is the bet ask price. So what more likely you see on Fidelity, when you execute the order, at market order, this is the number that is going to show up on your screen. 790, not the 830. So, hello, wait a minute. Look at the difference now, right? 830 to 90, we got $40 in here. Your net profit is going to be $175, selling at the market price, less commission fee that we don't want to talk about it here. But let's do one thing. Let's see what happened next. Oh, now the market closed and on 212, right? Now advanced micro device is up to 177, and you really are into some big bucks. Remember, you started at 299. And the actual live chart, you probably won't see this. It's disappearing because they keep on moving up. So now you are at 790. So you are over here. Your 172 had jumped over here, and it costs $1, right? 172.50. We will move it here, and this is how we do this, right? We can move it up and down. Up. Let's move this up again. So here what happened. Here you got it. and now it's 875. So now you got some serious money here, and now you're up to $1,157, right? When we take the 613 that we paid for the option, 613.13, we're now $1,100. This is the right time to sell, right? This is where you cannot be on emotion, oh, you're going to go more. I will take the money and run, right? But that's not the way. What we're going to see is now, remember, we don't have a crystal ball. It put now only worse, $1.89. But remember this, right? We don't have no crystal ball. We don't know if this is going to keep on going up tomorrow. So let's go to the next slide and see what happened. Well, guess what? Here we are, February the 13th, on the top of it, Tuesday the 13th, bad luck. The market opened at 167. Hello? Hey, yesterday we were 177. Now we lost $10. The price went $10 down on the opening of the market on a Tuesday, and a Buy Micro device announced that this is really happened. They announced the quarterly report with bad income report and lower sale after market close day before. And this is the problem. Now the option that you had, that it was $8.70, and you were $1,100 in the money, all kind of money, guess what? Now it's worth $2.07, which means that all you can get is what? $400, and you pay $6. Now you're in the hole $200 right here. Oop, I'm missing my cursor now. So we went from here to here, and now here we are. I don't see why my cursor is not showing. Oh, here we go. So Tuesday the 13th, so the option now worth $400, when at one time it was $1,700. And on the top of that, guess what? We down $200. Something like that happened to me, I sell it immediately. Notice that now the implied price per share that you might get is 32 cents, when before you were getting 79 cents for every share when it was at 172 right here, at this point right here. Actually, if we reduce the screen, then I can move this number up and down, but when we put it full size, then it don't let us do that. But thank God that it's working out. It shows where it goes. So here we go, 207 to 228, 226. But when you sell at the market price, this is the price you're going to get. So it's still got about 20 cents spread in there. And that's how the trade went. At this point, if I was involved on this, I take the hit for $200. I don't want to kill more soldiers. And actually, I could have brought the army yesterday victorious to home with extra soldiers, extra money to go and conquer the world. But this general got greedy, right? And he started trading on, oh, well, I think it's going to go higher. He said, you don't have a crystal dude. You don't have a crystal ball, guy. Don't do it. So here we go to the option trade consideration. How much do you want to make per day? Do you want to make $3,000 in 1 hour? Let's look at this. Well, the answer is, with 10 contracts at the price moving $1 at the money, your 10 contract will move up about from $350 to $450. So you'll be making money, but you don't want to make $3,000 in 1 hour. And remember, I like to trade within 1 hour. Okay, 45 minutes or less. There is no way for you to make $3,000 if the stock price needs to move $6. Here's another key factor. Here's some of the secrets that some people call it, this is not a secret, okay? But this is about opportunity that we talked before. In order for you to make this kind of money, you need to buy a stock, okay? You need to get involved with the stocks that they can move $6 to $10 a day. If you're gonna buy Coca-Cola and buy options on Coca-Cola, you're gonna starve to death. Why? Coca-Cola moves 10, 15 cents, 30 cents, well-established company, good dividend, but money-wise from price for option is a dog. You leave that to the guy, the king of Nebraska over there, that he owns millions of shares of Coca-Cola, and all he's interested is in collecting the 50-cent dividend that they pay him every 90 days. So he make about $6 million every 90 days just for the amount of shares that he owns on Coca-Cola. But for an option trader, for me, Coca-Cola is not the stock. And it's something that moves from $6 to $10 per day in order to make some money. And this is how you can make 3 grand. You get a stock that you say, now don't tell me, well, I'm going to buy NVIDIA because they move $80 a share. That's true. But NVIDIA's options are not cheap. You might have to pay $40 a share, and I'm only dealing with 3. I don't have that kind of budget to be doing that and taking the risk that it also can go down $100 on the stock and kill me very badly. But remember this. This is very, very, very important. And I apologize for not putting it at the beginning, but trading stocks, okay? When you trade option on a stock, you need to do and check a stock that has the possibility of moving from $6 to $10 a day. At the minimum, $5 a day. But if the stock can move that much in either direction, you're going to make money, but you have to be on the opportunity like I told you about it. You, as a general, you take those soldiers, that money, put it to work, and you go to conquer and bring more soldiers in. All right? Okay. If we increase the number of contracts, your risk also going to increase, but now you can increase the profit from the same $1 move on the stock price. There's another way of doing it, right? Is he only going to move $2 and $1 move only going to give you 50 cents? You got 10 contracts or something like that. Now, the only thing we can do is buy more shares, buy more contracts. That means that you have to bring more soldiers to the battle. And that is where the risk really get involved. This is why I buy 10 contracts and see how the market is going. And then as I see they're going my way, then I bring more contracts out so I can bring all the soldiers back and some more. So think about that. You might be able to make a move, but you have to be very, very, very sure that this thing, and we only have 30-minute window to make our money, 30 to 45 minutes. I don't want to know about after that, is I want to stay in that. So let's continue. Okay, so here's an example. With 20 contracts on $1 move, now you can move from $70 to $1,000 approximately. So now you have make $1,000, right? So 60 contract probably can make it happen. Since option price vary based on the volume, sellers and buyers, the market might increase the price. The market maker is going to increase the price. Okay? Nothing we can do about that. We have to live with what they give us. To reach your $3,000, you need 60 contracts for $1 move in 1 hour. Now, if the stock moves $6 in 4 to 6 hours, your your 10 contract can reach 3,000. Are we planning to stay in the market 4 to 6 hours? And the reason that I don't do that is because after 11 o'clock in the morning, the price kind of settle and then go flat or start going down and move up and down, and it never make the $6 or more. So rather than do that, I'm going to take it in 30 minutes. Take what you can while you can. So be careful if you plan to stay 6 hours in there or from one day to another, because it might be good, it might be not, and I just don't trust it. Let's go to the next slide, and here we are. However, the risk time needs to be considered. Watching the price move for 6 hours is not for everyone. For a day trader, it needs not to let the emotion factor get involved. So we're going to look at some of my trades here that I had done. And normally in the morning, when before the market opens, I draw a line and what I'm expecting to happen, and then at what time I expect the price to go up. So this is a chart of a band micro device. Like I told you, I traded a lot, and this is what happened. The day before, I drew this line, and this is what took place. And then I expected about 1 o'clock it was going to do this, and that's what happened. So this morning, the market have opened. This is July 30th, and I'm drawing a line that I expect the price to go up. So here we go. Never trade on the first 30 minutes of trading. That's what I let this thing go. And now I expect it to go up, but guess what? It went down first, and now we're going to see what is going to happen. This is some of my tools, the indicators. And here we are. Now at 11 o'clock, it finally reached over here, and now I'm moving up. It's doing exactly what my little line I put in there, right? Yesterday, I missed it. You can see here that I expected it to go up, and it did. And then when it crossed this line, it even reached here. It started going down much sooner, right about that time, but not at the level that I expected. So if I have stayed over here with my option, I would have lost money because it would have killed me. Now today it started like up, but not good, eating whole, and now by 11 o'clock going this way. Here we are at 1 o'clock, and we're just touching this line. So let's move to the next slide to see what it's doing. And here it is, right? This is for 8-3, so that was what day was this? This was 31 of July. Now here's some of my trades. Notice how I draw this line, okay? And I expected to go down on the day before. It didn't happen. It just stayed flat. And now this morning we expect it to go up, and this is August the 3rd, and I move in and I enter right here. I enter it ahead of time because I saw these two indicators moving upward. This is about part of the chart setting, and now we're dealing at the options, but we put certain indicators here that tell us in a way, in a mechanical way, what is possible going to happen. So sure enough, they start separating and moving up, and the price started going up, but then a little bit after 10 o'clock, we went into a flat spot. I was very worried about this, but I stayed because my line here had not moved, right? My line here, it had not touched this line yet, what I draw. And then it continued to going up, but at this time, this line got closer, so I decided to sell. I just barely got here, so my entry point was right here, and I exit right here, and that happened in August the 3rd, 2023 live seminar, option trading. We got a video about that you're going to see later. And I netted 2,000, right? I netted $2,140. The rest of the day, I don't know where it went. And then now we get to the next day that is going to be, I don't see the date over here, August the 3rd. So now August the 4th, we're coming over here. And this is what expected to happen. We expected to go up and then down. Yesterday, after that May, look what happened. It went haywire and we lost it. And here we are again, right? So here we are now, August the 3rd. Markets open, getting here, and we get off right here. This is when they made the 45-minute trade. This is the complete chart, actually what it looked like when we pasted. And I say those things on the book that I was showing you. Now, this is one that it was done live that is on the video. This is recently, we got in August the 4th, 2023. We start trading, we buy the stock, and now we got how many contracts? We got 20 contracts on margin, and we up $572 right here. So I'm up 15% of the money already of what I invested on it. I only invested $3,667.60. Now let's see what happened on the next deal. Well, guess what? We are here, and now we are $1,600 up. Okay? Now we are 43% up, and I only invested $3,667, so it's a few cents. So now I'm 43% up. My 20 contracts are making a killing, and I decided to go ahead and sell. Here's what I want you to see that is very interesting. I see this when I refresh the screen, and I have my order ready to go. Make sure that when you're doing this, you have a way to put the screen of what you got the order ready to place it. You're just going to click here and go. So I'm refreshing this, and I'm also looking further down at the chart, how it's moving, and the indicator. So you're dealing with three things at the same time. How much your option goes up, having the order ready to go, to click here and place the order and get out, and look at the chart that is in a different window to see. So this is why sometimes this guy got different screens so they can see what's happening. I'm a cheapskate, I don't do it that way. I got him on a horizontal line at the top of my screen, and I just look at it, come back over here and refresh. When you click this button here, I will see this. Now, so at that point, I saw $1,600. I say, hey, 43% of my money, I'm gone. I press this button and boom, the order went in. August 3rd, you bought opening transaction, 3,122. They were processing it, so this is now all done. Here we go now, and you sold it, and 20 minutes, he said that the total sale is 5,700, so we need to deduct what we pay for, and this is what it gives us, $2,303.75, and it took me 20 minutes to do that trade, okay? And I also got charged $167 commission. So the $3,000 that we got here, right, and stuff like that. So I want you to look at this, right? 500, we were at 20 minutes. This thing start going our way, and we go from here to here and get out. Now, here's the deal. We netted $2,300, okay? And the total time that it took, you can see right here, we went in at 9:56, right? And we got out 9:56, and we get out 20 minutes later, and this is how much money we make. So it can be done. Now just remember that you have to be on guard. Look how right here, by the time I saw the 1600 and was willing to get out. All I had to do was this: move my cursor from here to here. Boom, place the order. When the screen roll over, this is what I get, and then we put the amount. My 1600, by the click of this, while it process of rolling the screen, it went up another 600 and something dollars. I was at 1612, and now I'm at 2300. So it almost went almost $800 because I took 170. So this is how fast this thing can move. I was lucky enough that I was willing, satisfied with $1,600, place the order, clunk, the screen roll over, and here I am with $2,300 when I was expecting to get 1,600. So here we come to the end of this part, and we see you when we put the other stuff on this video. So thank you for your time, and I'm sorry, but it had taken 1 hour to explain this, and that's the way it is. So we're going to continue. This is not over yet, but we're going to have to move into part 2. Thank you for your time, and I see you on the other side.